Hello class, welcome to Module 1, Bank on It. In this module we'll start looking at steps we can take toward building financial wellness, starting with a focus on understanding the basics of personal finance. Let's talk about what we'll be covering in this module. The objectives include identifying the major types of insured financial institutions, such as banks and credit unions, reasons for using a bank, the steps involved in opening and more importantly maintaining a bank account, and also we will describe the two major types of accounts, identify the types of services that most commonly come with holding an account, and describe the main functions and responsibilities of the various personnel at a bank. If there are ever matters to discuss at a bank, it's always best to know who to talk to. One quick caveat before we go further. There are going to be topics discussed in this and other lectures that you may already know or understand. It may seem silly to spend time reviewing them, but please understand and respect that we all come to understand financial wellness from different places, and not all of us start at the same point in regards to this subject. I ask that we remain sensitive and respectful to each other during this course. Also, the modules in this course have been designed to serve as standalone financial wellness modules, meaning later on if you want to review a single topic covered in a module, you can do so without having to watch all the other modules for it to make sense. That being said, there may be some overlap between the modules in terms of concepts, terms, and ideas. What do you think about when you think of a bank? For me, I associate the word bank with drive-through teller windows and ATMs. Are banks something you've ever even thought of? What's your experience with banks? Do you currently use one? Do you plan to use one in the future? For those who have used banks, have they been sources of satisfaction or joy, or have they been sources of denial or frustration? In case we're not sure, banks, credit unions, and thrifts, also known as savings and loans, are businesses that offer you a safe place to keep your money and use your money to make loans to other people. Banks, credit unions, and thrifts are also called financial institutions since they offer many financial services. For the sake of clarity and brevity, for the remainder of this lecture I'll use the word bank to simply describe any financial institution unless I'm speaking of a specific type. Why would you want to keep your money in a bank? There are a number of benefits for doing so. First and foremost, banks offer safety, to keep your money safe from theft, loss, and fire. Second, banks are convenient. You can get to your money quickly and easily. If you use direct deposit through your work, you can typically access your money much faster than with traditional paper check deposits. We have all probably used an automated teller machine, an ATM, to complete some sort of financial transaction. Conveniently located, ATMs are typically available 24/7. Third, if your bank offers a debit card, you can use it in place of a credit card to make purchases. Cost. The cost of using a bank to cash your check is always less expensive. And the Federal Deposit Insurance Corporation, the FDIC, insures deposits up to the maximum amount allowed by law. This means that the FDIC will return the money to the customer if a bank closes and cannot give its customers their money back. Last but certainly not least, building a relationship with a bank establishes a record of paying bills, can help you save money, and can help with getting a loan. So let's cover a few points about banks, thrifts, and credit unions. Banks and thrifts, which are not all that common anymore, must adhere to both federal and state laws. They can make loans, pay your checks when or if you write them, accept your deposits, and provide other financial services such as auto or home loans. Credit unions conduct all of the same services, but have a few additional features. They are nonprofit institutions, meaning they are not seeking to gain profit from the money you deposit with them. They also require some type of membership to use their services. You have to become a member of the credit union to keep your money there. There are credit unions established to support a number of different types of professions like teachers and educators, or even grocery store employees. All of these types of financial institutions operate under federal and state laws and regulations. Deposits in insured banks and thrifts are insured by the FDIC up to at least $250,000. This means that if the bank were to fail, the FDIC would return your money up to the insured amount. You can tell if the FDIC insures a bank by looking for the displayed FDIC logo. Most credit unions are insured by the National Credit Union Administration, the NCUA. The deposit insurance rules are the same at the NCUA insured credit unions as they are at FDIC insured banks. The FDIC has an online tool called the Electronic Deposit Insurance Estimator, EDI. It lets you calculate the insurance coverage of your accounts at each FDIC insured institution. You can find ED online at www.myfdicinsurance.gov. No matter which type of financial institution you use, all of them use some basic banking terms that you will have to know in order to open an account. In theory, opening and maintaining a bank account is not as difficult as you might think. The foremost basic things to know are 1. Open the account. 2. Make deposits and withdrawals. 3. Record interest and fees. 4. Keep track of your balance. The first thing you need to do to open a bank account is to go through a process called account verification. The bank will want to make sure that you will be a responsible bank customer, you are who you say you are by verifying your identity, and are able under the law to open a bank account. Ask the bank what type of identification you need to open an account. You will need to prove your identity, such as show a state-issued driver's license or ID card. If you're not a citizen of the United States, some banks may accept other forms of photo identification, including the matricular consular card, resident alien card, known as the green card, or a passport. Typically, any government issue ID displaying an ID number in the country of issuance is accepted. You'll need to provide your Social Security number or individual taxpayer identification number if you have one. If the bank determines that you are eligible to open an account, you can deposit money into your new account. If you are not eligible, ask about second chance checking programs. These programs may require you to meet certain requirements, such as completing a check writing workshop. Ask your local financial institution and/or reputable credit counseling agency if there are programs in your area. And consider opening a savings account if you've had trouble managing a checking account in the past. Now we'll look at some of those banking terms associated with opening and maintaining an account. A deposit is money you add to your account. When you add money to your account, you must fill out a deposit slip. A deposit slip tells the bank how much money you are adding to your account. If you deposit a check, you may not have immediate use of all the funds. The bank must make sure that there are funds at the originating bank. That's the bank of the person or business who wrote the check, to cover your check. You should ask the bank when you can use the money you deposited. If you deposit cash, it's usually available immediately. Deposited checks may be partially available, meaning the bank may allow up to a certain amount of the deposited check to be withdrawn immediately, and then hold the rest until it clears, meaning the funds are all available for withdrawal. The balance is the amount of money you have in your bank account. We're going to use this table to keep track of the money we add to and take out of our accounts. Looking at the table, what is the balance of this account? Right, $100. When you make a withdrawal, you take money out of your bank account. You do this when you write a check, give a teller a withdrawal slip, or use an ATM. A withdrawal slip looks similar to a deposit slip, except you use it to take money out of rather than add money to your account. You always need to know how much is in your account so you will not try to withdraw more money than you have. If you take out more money than you have, that is called overdrawing your account. If you overdraw your checking account, you will be charged a fee. We'll talk about those fees later. So looking at your table, you see a withdrawal in the amount of $20 was made. Did it change the balance of the account? It did. The account balance is now $80. Now let's talk about fees. There are some common fees you may see financial institutions charging for their service. A monthly maintenance fee may be charged to keep your account open. The fee may be $0 under certain circumstances, such as you have regular direct deposits made to your account, or you maintain your minimum account balance. A penalty fee, if you misuse your account, such as when you overdraw your account by withdrawing or spending more money than the amount in your account. Many financial institutions offer options in the event that you overdraw your account. Be sure to look carefully at the fees associated with fee-based overdraft programs, as the fees can be very costly. Your bank may offer lower cost options to cover overdrafts, such as linking your savings account to your checking account to cover them. Remember that with most fee-based overdraft programs, unlike an overdraft line of credit, there is no guarantee that your bank will cover your checks, ATM withdrawals, and debit card or other electronic transactions that overdraw your account. We'll spend more time talking about how to avoid overdrawing your account in Module 3, though. So now that we've discussed fees, let's look at our table again. You began with an opening balance of $100. You withdrew $20, bringing your balance down to $80, and the bank assessed a $4 monthly maintenance fee. After all those transactions post, your balance is now $76. Let's move on and discuss deposit accounts. Deposit accounts are those in which you can add or deposit money. Checkings and savings accounts are examples of deposit products. A checking account allows you to pay bills and buy goods with the money you have deposited. Therefore, when you write a check, use an ATM or debit card, or bank online, the financial institution takes the money from your account and pays it to the designated person or business. Some checking accounts may pay interest. A savings account often earns interest, generally cannot be used like a checking account, but may allow you to use an ATM or debit card. When selecting or opening a deposit account, be sure to understand the fees, such as the monthly transaction fees. For example, you can often open a savings account with a few dollars, but you might pay a monthly fee if the balance is below a certain amount. A bank is required to provide a disclosure of all fees prior to opening an account. You can use this disclosure to comparison shop between banks. The bank will help you monitor your account by sending you a statement. The bank statement lists all of your deposits, withdrawals, fees charged to your account, ATM and debit transactions, checks written, and other messages to you. Bank statements are addressed in greater detail in Module 3. It's a good idea to compare the rules of the different accounts. Banks might require you to have a certain balance to open an account, earn interest, or avoid fees. This is usually called a minimum balance. Remember, when looking for an account, it can be helpful to take a bank and bank account checklist with you. It can contain questions which help you choose an account that is right for you. You'll have an opportunity to complete one this week for your financial wellness assignment. Now let's take a look at the differences between using a check cashing service versus a bank to handle cashing checks. Even though banks may charge monthly fees, it's much less expensive to use a deposit account at a bank than a check cashing service. If you tend to use a check cashing service, how many checks do you cash per month? How much you charge per check? Here's a check cashing example. Let's say you cashed 4 checks a month and were charged $5 each time. That means you paid $20 a month or $240 a year just to cash those checks. If you buy money orders, which are financial notes that allow the individual named to receive the sum of money on the note, that costs you $1 each to pay 5 monthly bills. You'll pay $60 per year. The yearly cost is now $300. That's $240 plus that $60. Let's look at a bank example. Let's assume you have an account at a bank that charges a monthly fee of $5, which includes 8 free checks per month and free use of the ATM. Ordering a box of checks through a bank costs about $18. In this case, using a checking account for 1 year costs $78. Using a bank in this situation saves $222 a year. Additional benefits worth mentioning when comparing banks to check cashing services are: financial institutions provide the convenience of internet banking with access to your accounts and information 24 hours, 7 days a week. Using a bank account responsibly can help you establish a positive banking relationship, which may be helpful if you ever apply for a loan. You do not have to worry about cash being lost or stolen, and you can easily save money for the future. These are benefits you would not gain from a check cashing service. One of the advantages of having a deposit account is the interest you earn. Interest is a percentage of your balance that the bank pays you for keeping your money at that bank. That is, if the account pays interest. Please keep in mind most checking accounts do not pay interest. Savings accounts are the most common interest-generating deposit accounts. Looking again at our table, assume the balance in your account earned $1 in interest just for being there. It now brings your account balance to $77. Now let's cover non-deposit accounts. Many banks offer non-deposit accounts or products that are not insured by the FDIC. Stocks, bonds, and mutual funds are examples of non-deposit investment products. These carry some level of risk, meaning that you could lose some or all of the money that you invest in these products. Bank personnel should provide a written explanation that these products are not insured by the FDIC and may lose value. It's important to understand these products and services before you buy them. You can find out more about non-deposit products through your bank. Banks provide additional services with some deposit accounts and may charge a fee for those services. It's important to keep track of those fees charged, if any. The following are common services that banks offer: direct deposit, money orders, telephone and online banking, ATMs, money transfers, debit cards, stored value cards, loans, and remittances. You've probably received privacy notices in the mail from banks and other financial companies. Privacy notices explain how the company collects, handles, and shares your personal financial information, how your personal financial information is protected, and how you might limit the company from sharing your information with others. You will receive an initial privacy notice when you open your account and every year thereafter. Federal law requires financial institutions to keep your personal financial information private. The general public does not have access to your personal financial information. However, financial institutions may share your information with other companies to offer you other products and services. Federal privacy laws give you the right to stop or opt out of some sharing of your personal financial information. If you prefer to limit the promotions you receive, or if you do not want marketers and others to have your personal financial information, you should 1. Review the privacy notice from each financial company you do business with to determine whether the company shares information with others. 2. Tell the credit bureaus not to share your information with lenders and insurers who use the information to decide whether to send you unsolicited offers of credit or insurance. Not all companies will share information. If your company shares information, your privacy notice will contain instructions how to opt out. You have the right to stop or opt out of some sharing of your personal financial information with companies that are part of the same corporate group as your financial company, or not part of the same corporate group as your financial company's affiliates or non-affiliates. In addition, you can opt out of receiving certain offers of credit or insurance by calling 1-888-5-OPT-OUT. That's 567-8688. Or by visiting www.optoutprescreen.com. It's important to know that you cannot opt out and completely stop the flow of all of your personal financial information. The law permits your financial companies to share certain information about you without giving you the right to opt out. Among other things, your financial company can provide to non-affiliates are information about you to firms that help promote and market the company's own products or products offered under a joint agreement between two financial companies. Records of your transactions, such as loan payments and credit card or debit card purchases, to firms that provide data processing and mailing services for your company. Information about you in response to a court order, and your payment history on loans and credit cards to credit reporting agencies. Financial institutions have various employees who can help you with different banking services. Understanding their roles helps you know who you should talk to when you go to the bank. The primary bank employees to be familiar with are the customer service representative, who helps you open your account, explains services, answers general questions, refers you to other employees who can help you, or provides written information explaining the bank products. The teller deposits your money for you, cashes your checks, answers questions, and refers you to other employees who can help you. The loan officer takes applications for loans offered at the bank, answers questions, provides written information explaining loan products, and helps you fill out a loan application. The branch manager supervises all the branch operations and helps fix problems that other employees cannot solve. Some key points to remember. Ask for help if you do not know who to talk to at a bank. Ask questions until you're clear on all the information. Do not sign anything you do not understand. Ask for written information to take home to review. Use the Choosing a Bank and a Bank Account checklist that you'll complete to help you choose a bank and the account that's right for you.